Hi, I'm Carrie Hunt, NAFCU Senior Vice President of Government Affairs and General Counsel. And today I'd like to give you an update on some of our advocacy efforts as we close out 2014 and look ahead to 2015. First of all, I want to thank all of you for all of your participation this year in our advocacy. In particular, all the comment letters you wrote on risk-based capital, I think were particularly effective in making sure that both the regulator and the policymakers on Capitol Hill really understood how that proposal would impact you in terms of how you run the credit union. Speaking of risk-based capital, I want to remind everyone that Chairman Debbie Matz has indicated that she hopes to have a new proposed rule addressed at the NCUA board meeting in January. Whether or not the staff and that rule is ready to be released at that date remains to be seen, but that is the date they are pushing on. We do expect a number of significant changes to the proposal, in particular relative to risk weights. We also think there are going to be some changes to legal definitions. There also will be changes to interest rate risk. NCUA has said that they are going to address interest rate risk not in the risk-based capital rule, but address that in a separate rulemaking. I want everyone to be assured that we certainly do not think that our work is done relative to risk-based capital. We absolutely need a proposal, that rule that is not going to negatively impact credit unions and accurately reflects true risk in the system. NAFCU thinks that we need to have legislative changes relative to capital, ultimately to have a fair risk-based capital system, but in the meantime we will do everything we possibly can, both on the regulatory side and on the legislative side, to make sure that we end up in a positive space. Relative to interest rate risk, NCUA has not given an indication as to exactly how they're going to address this relative to their rulemaking, but we continue to talk to the agency about this as well, and our economics division, headed up by Kurt Long, continue to model and look at interest rate risk, to talk to our members as to how the examiners are looking at interest rate risk. We know that there are some issues in that regard, and we're continuing to advocate on your behalf with the NCUA. I also wanted to mention a few other rules from other regulators that are of key importance and will continue to be of key importance for next year. The first is the overdraft. The Consumer Financial Protection Bureau, well over a year ago, announced that they wanted to look at overdraft. They issued one report relative to overdraft protection, and now it appears on their semi-annual regulatory agenda. Recently, the NCUA board met with Director Richard Cordray and discussed overdraft protection, and it looks like that the CFPB is really focusing on three key areas relative to overdraft. One is the reordering of transactions, whether or not institutions are reordering transactions so that consumers have to actually pay more in overdraft fees is of key importance to the CFPB. The second area is really disclosures. The CFPB is looking as to whether or not institutions' disclosures adequately inform a consumer about the ins and outs of the program. And also whether or not there should be limits on transactions, whether or not what is too much relative to the cost of an overdraft in proportion to the actual purchase. The CFPB is aware that for a lot of institutions, in particular smaller institutions, overdraft fees can be an important part of their fee income, but we will continue to make sure that the CFPB has a firm understanding of how overdraft protection programs work, how credit unions look out for their members relative to overdraft, and some of the alternatives that credit unions also offer relative to overdraft protection programs. I also want to mention a proposed rule that the Department of Defense has issued. The Military Lending Act is a separate piece of legislation that authorized the Department of Defense to issue regulations to prohibit service members of all ranks, their spouses, and dependents from engaging in certain financial transactions. Now, back in 2007, when that statute was passed, it was intended to target certain specific loans that were considered to be predatory. And the rule of the Department of Defense issued at that time was very narrowly limited to payday loans, vehicle title loans, and rent-to-own programs, refund anticipation loans, and military installment loans. Now, there are certain products have fallen outside of that parameter, and the Department of Defense has come back with a new proposal that vastly expands the universe of products that are covered by this proposal. It includes credit cards, student loans, overdraft lines of credit, personal lines of credit and installment loans, car and other secured refinancing loans, and some mortgage loans. Of course, for credit unions, there is a cap on interest rates. The NCUA looks to the Regulation Z definition of credit relative to the ceiling on interest rates that credit unions have to comply with. So credit unions have a unique interest in this rulemaking and how the rule potentially defines credit. This is a rule that we are in the process of commenting on right now. The Department of Defense, at our and others' urging, did extend the comment period, so we are advocating on your behalf in this regard. I wanted to clarify that this potentially will impact any credit union that offers these types of products. This rule is not just for credit unions who are really military or Department of Defense credit unions. It impacts any credit union who has a service member or spouse dependent as a member. When a service member comes to the credit union and wants an extension of credit, potentially under this proposed rule, the credit union is going to have to check proactively to see whether they are a service member. And this will be, of course, an additional regulatory burden for the credit union. Let me also talk about a few legislative issues. By now, you probably read that the Senate and House passed the Interest on Lawyers' Trust Account bill that we have been pushing for. So now, credit unions who want to offer these types of account will be able to do so because there will be full insurance coverage for not just the member who starts the account, but all of the clients of the attorney who's holding those funds in trust. NCUA has some legal opinion letters which indicate that credit unions can't offer these types of accounts for that reason. So those will have to be superseded. Potentially, NCUA could make additional changes to their regulations to clarify how credit unions treat interest on lawyers' trust accounts. But to clarify, this is a statutory change. So it's now on its way for the president to sign, and hopefully this will be effective in the next couple of days. I also want to mention some other legislative issues for next year. One is, of course, NAFCU will continue to protect the credit union tax exemption. We've been very active in making sure all members of Congress understand the importance of the credit union tax exemption. We commissioned a study that we released last year talking about the importance of the credit union tax exemption and its benefit on the economy at large. We have many new members of Congress next year, and we will, of course, continue our education efforts in that regard as well. We also will be continuing our work on data security to make sure that we get standards in place for merchants that mirror the same type of standards that credit unions already have to comply with. And we also will be continuing our work on the regulatory relief front. Now that we have a Republican Senate and a Republican House of Representatives, we expect that there will be a lot more reform measures considered relative to aspects of Dodd-Frank and the CFPB, and we will be actively lobbying and pushing for potential changes in that regard to help credit unions on the regulatory burden front. With that, we expect a lot of additional robust discussion next year on a government-sponsored enterprise reform, and that, of course, is another key issue for credit unions as well. I am very excited as we are closing out 2014. I think that together we've achieved a lot relative to getting another comment period for risk-based capital, getting interest on lawyers' trust accounts legislation passed, but there's a lot more work that remains to be done in 2015. NAFCU is continuing our push of enough is enough on the regulatory side. We need change on the regulation, both from Congress and at the regulators, and we expect to continue that next year. I hope everyone has a great holiday season, and I look forward to speaking to everyone as we head off 2015.